James Pardoe, How Buffett Does It, 24 Simple Investing Strategies from the World's Greatest Value Investor, Mighty Managers Series. Welcome to a summary of How Buffett Does It, 24 Simple Investing Strategies from the World's Greatest Value Investor, by James Pardoe. In this book, we explore the investment philosophy of Warren Buffett, who transformed himself into a billionaire with no inheritance through value investing. This summary will uncover Buffett's straightforward approach and key principles, such as developing emotional balance, patience, independent thinking, buying and holding, and studying companies' bottom-line results. Get ready to learn about Buffett's methods and how to apply them to your own investment journey, along with the importance of understanding businesses and cultivating a long-term perspective.
Warren Buffett's simple investing philosophy. Warren Buffett's investing philosophy is straightforward and effective. He advises investors to choose a simple approach, develop emotional balance, be patient, think independently, invest in a few choice holdings, and study companies' bottom-line results. He warns against being distracted by economic events and being overactive. Buffett recommends buying and holding and taking advantage of unexpected opportunities. To apply his methods, study accounting, cultivate healthy skepticism, and learn about his track record. With no inheritance, Warren Buffett is now worth more than $40 billion and considered the world's most successful investor. The art of value investing. Many people believe, wrongly, that investing is an arcane mathematical process and they need professional help to participate in it. However, the legendary investor Warren Buffett believes that anyone can learn to practice value investing. According to Buffett, investing in companies that you understand is crucial. Instead of trying to apply complicated formulas, trust your instincts and focus on finding valuable assets that are being sold at a price cheaper than their valuation. Buffett learned this approach from his mentor Benjamin Graham, who developed the strategy that was outlined in the book Security Analysis. Graham and Dodd's approach is simple: buy companies with great management, talented employees, and hold on to them for dear life. Buffett applied this technique to transform a $10.6 million stock purchase of the Washington Post into a $1 billion investment. Similarly, he turned a $1 billion Coca-Cola investment into $8 billion and grew his $45 million worth of Geico insurance stock to $1 billion. By buying and holding discounted stocks, he turned Berkshire Hathaway into a $100 billion company. Buffett doesn't depend on technology; instead, he focuses on analyzing businesses and using his gut instincts to make investment decisions. Through sound investment practices, he has transformed small investments into incredible success stories. Buffett's advice for investors. Don't rely on investment professionals, but instead, find a few great companies and hold on to them. Investment professionals have a conflict of interest as they earn money from commissions and fees and are mainly interested in portfolio turnover. Value investing is simple and anti-establishment, making it unpopular among investment professionals. However, this approach has worked for Warren Buffett, and his success shows that individual investors can make their own decisions. Investing with rationality. The key to successful investing lies in maintaining rationality, keeping emotions in check, and focusing on business performance, not price performance. Warren Buffett advises investors to avoid the Chicken Little mentality and not get swayed by market fluctuations or bad news. When faced with setbacks, evaluate your original decision objectively and stick to it. Heeding Ben Graham's advice, Buffett stresses the importance of having the right temperament to withstand market volatility. His own mistakes have taught him the value of patience and a long-term approach to investing. A good example is how he weathered the 50% decline in Berkshire Hathaway's stock in the 90s. Smart investors see such drops as a golden chance to buy rather than sell, as value investing never goes out of style. Ultimately, investing is not about chasing stock prices, but about investing in good companies and assessing their business performance. Cultivate patience in value investing. Warren Buffett, the legendary value investor, considers himself a decades trader and emphasizes the significance of cultivating patience. He proposes a simple yet profound thought experiment to differentiate short-term traders from long-term investors. Imagine the market closes for 5 years the day after buying a stock. If that doesn't affect the decision to purchase, it is a long-term investment. Buffett stresses that earnings and cash flow are two essential pillars of a successful company. To demonstrate the value of investing for the long term, he cited the example of 25 families in his hometown Omaha, who held their Berkshire Hathaway stock for 35 years. Their original investments of about $50,000 are now worth more than $100 million each. The value of an share of Berkshire Hathaway has appreciated tremendously over the years. Buffett advises investors to search for companies that are likely to outperform peers over the long run and think of investing in Berkshire Hathaway stock as they would of buying a farm or apartment building, an investment that will stay in the family for a long time. As proof of his conviction, Buffett has never sold one share of his company's stock in 40 years. Buffett's investment strategy. The article highlights Warren Buffett's investment strategy, providing insights into his investment philosophy. Buffett believes that investing in a volatile business is better than investing in a volatile stock. He looks at the long-term performance of a business, examines its operations, and compares it to its peers. His investment philosophy revolves around investing in industries as a whole, not just stock prices. He believes in buying only those businesses that lead their fields, sell things people need, have few competitors, and are not subject to pricing regulations. Buffett invests in low-tech businesses like candies, underwear, bricks, paint, carpets, and furniture, and avoids high-tech, new economy companies whose stock prices can easily become inflated. He doesn't follow daily or weekly news on stocks but focuses on business activity instead. Buffett waits for the right stock to invest and believes in taking a large position in good companies rather than diversifying. His strategy of low turnover reduces taxes and bolsters returns.
As we conclude our summary of How Buffett Does It, we've seen how Warren Buffett amassed his fortune by following clear and simple investing principles focused on value. The takeaway messages are to practice value investing, study accounting, be skeptical of brokers, cultivate patience, make rational decisions, and focus on business performance rather than stock prices. Not only does Buffett invest in stable, low-tech companies with a long-term perspective, but he avoids over-diversification and places emphasis on companies with strong management and dedicated employees. By following these principles and learning from Buffett's experiences, you too can potentially achieve long-term success in the investment world.